Hi, I'm Bob French. Today I want to talk a little bit about whether it makes sense to rebalance your investment portfolio when the markets have started to drop. When stocks are having a hard time, it just feels wrong to go out and sell your bonds, which, if we're experiencing a flight to quality, might actually be doing pretty solidly, and buy those same stocks that have just lost you so much money. But it's really important. There's a reason that you designed your portfolio the way that you did. And a good portfolio is designed so that you can stick with it through all types of market environments, good, bad, and ugly. And rebalancing is how you stick with your portfolio. No matter what the markets happen to be doing, they're constantly pushing and pulling your portfolio all over the place. And every once in a while, you need to bring everything back into line. But it's just a lot easier to do from a psychological standpoint when things are going well. As we're thinking about all of this, you want to try and keep the fear versus greed roller coaster in mind. Basically, we want to be on this boring, flat line in the middle. That's the straightest path to where we want to go. Problem is, we're human. And most of us are on the roller coaster here. And I'm absolutely including myself. We all get excited when the markets are going up, and we all get scared when the markets go down. That's perfectly reasonable. The question is, what do we do about it? Most people start by buying up stocks and taking on more risk when the markets are going up, and then aren't able to stay disciplined when the markets start coming back down to earth. We want to at least pretend we're on that line here in the middle, though. We want to stick with the portfolio that we've designed through whatever the market throws at us. And, well, deciding not to rebalance when the markets have dropped is not staying on that line. It's certainly not panicking and selling out of everything, but your line is starting to look a little bit like it's got some rolling hills in there. There's really only two reasons why you would choose not to rebalance. First, you're trying to time the market or avoid catching a falling knife or whatever other euphemism that you want to use. You think that the market is likely to keep going down, so you don't want to double down on your losses. The other reason is that your asset allocation isn't right. Or it might be a little of column A and a little bit of column B. But let's deal with the market timing question first. You can dress it up all sorts of different ways, but a lot of the time when people don't want to rebalance is when things are less than rosy. It's because they think the markets are going to keep going down, and they don't want to buy in just to lose even more money. The problem is, it's all but impossible to guess what the markets are going to do next. Markets incorporate new information incredibly quickly. By the time you or I hear about something in the news, it's probably already in the prices. What drives prices is what happens next, and crucially, how that news squares with what the markets expected to happen. In other words, unless you can predict the future, market timing is probably not the strategy for you. To put it bluntly, trying to time the market is not a good reason to refrain from rebalancing. But let's deal with the second reason you might want to avoid rebalancing when the markets have not been cooperating. That you just got your asset allocation wrong. And this is the much more interesting reason. In fact, we have a whole video specifically on this, which should be up in the corner over there. The answer still comes out the same. You really should rebalance your portfolio, but there's a sliver of light there to work with. Now, I'm starting with the presumption that your asset allocation is appropriate for your situation, both in terms of your risk tolerance, how much bouncing you can take from the market, and also in terms of what you need out of your portfolio so that you can reach your larger retirement income goals. I don't know about you, but I don't invest for the fun of it. We do this because we're using our investments as a tool to reach the retirement that we want. But that being said, During a big market movement, either way, you're getting new information about your risk tolerance. When we're designing our asset allocations, we can do some serious introspection and look at how we've acted in the past, but we're still making guesses about how we'll feel when the market falls out in the future, and whether we'll be able to stay disciplined or not. And just like anything else, sometimes we're going to get it wrong. You may be in a situation where you've built your portfolio to take on a little bit too much risk. Now that we're experiencing what risk actually means, it's a little more nebulous when the markets just keep going up. But if you think your portfolio is a little bit too risky, you owe it to yourself to take a hard look and try to figure out if this is just you being nervous because the markets happen to be dropping right now, or if your risk tolerance really is lower than you thought it was. But let's say that you've done the hard work, and this isn't just your nerves talking. Well, the most important thing is staying in the market to the largest degree possible. If delaying your rebalancing helps you to stay disciplined when you wouldn't have otherwise, well, there are worse things. But it's important to recognize this is a second best solution. You're cheating a little bit so that you don't cheat a lot. Once things start to settle down, you'll want to get back to your asset allocation as soon as possible. But then you'll need to sit down and take another look at your asset allocation. You've just gotten some really valuable information about your risk tolerance, so you owe it to yourself to incorporate all of that into your asset allocation going forward. To make sure I'm being clear, if you need to hold off on rebalancing, your asset allocation is probably too aggressive, and you probably will want to pull it back, at least a little bit, when things have started to settle down and we can go back to thinking about things at least a little bit more rationally. So where does this leave us? Well, basically, you probably want to rebalance your portfolio to your asset allocation when things get out of whack, assuming that your asset allocation is appropriate for you. Holding off on rebalancing really only makes sense to me if the alternative is getting out of the market entirely. If it's the crutch that helps you maintain most of your discipline, that's great. But almost everyone who is prepared during good times really should be rebalancing their portfolio. It doesn't feel good, but rebalancing, even when the markets are going down, is crucial to helping you get the most out of your investment portfolio. If this was helpful, be sure to like this video and subscribe to our channel so you can see what we're up to. If you have any questions on this, or if there are any other questions that you'd like me to address, just drop them in the comments below. You can also check us out on the web at retirementresearcher.com and make sure to sign up for our weekly newsletter to keep up to date with everything that we're doing.